Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, March 16th, 2022. All right, so let's go over what happened today. Of course, the big Fed meeting today and volatility as expected. And I want to share where we're at right now, give you my thoughts, which is essentially, just tell you in a nutshell, a good time to keep things light right now. I am not at this point adding any more short exposure. I told you yesterday or the day before, I started to pivot a little bit, laid out a long bounce trade, and then also mentioned, starting to reel in some of the short exposure because a couple reasons. I'm going to show you that. Number one, we were the risk reward the other day, a few days ago, was clearly skewed to the downside, meaning we weren't at risk of breaking out, but we've since broken out of this 60-minute downtrend line. Not by much. I need to say that. Two things. Number one, it is a Fed day, and take whatever happens on a Fed day with a big grain of salt. As I always tell you guys, the initial reaction is typically not the lasting reaction. Here's a 1-minute chart of QQQ. This is right here. It's 2 p.m. mark. It's right there. So there's the initial reaction. And it's funny, you can almost bank on the initial reaction not being the lasting reaction, at least not today it wasn't. So immediately from the announcement, the NASDAQ 100 dropped 2%, turned around, and then rallied from that point 3.7%. That is textbook FOMC post-Fed noise is what I call it. But it was also very tradable. Had the great day, active trading. Just want you to know, if you're new to the site, that active trading is not what the site is about, at least primarily, mostly swing and trend trading. But with with the Fed being up this week, as I said, about the one thing you're guaranteed today, or were guaranteed going into today, was volatility, especially the last few days, and that's exactly what we've seen. And couldn't have traded it better. Laid out the pullback target here this morning, first saying we're close to that level, and when we hit the 334.74 level, then I followed up with a post that we had hit the downtrend line, and that was, just reiterate, that was an objective level to go short. Then got out to you some short-term pullback targets. I was in and out of, I had some things come up today, had to keep walking away from the desk, but got out to you what I could. Told you that's where I covered right there. My short pullback target was hit, and that was 13,476. That was pretty much the lows of the day post-Fed. That's got back to my desk and then told you, we'll go long there. Posted that as an objective long, pullback target being hit, and said when we got up here, was targeting at least at 13,620, but instead of taking profits, that post I said I would trail up. That may have been in the comments section. I'll have to look below that last post, but would say I would just trail it up, and that's what I did. Just let it run. Now at this point, where we go, I would continue to raise either manually or trail stops if you're actively trading, because here's what happened. Let's look at the 60-minute charts. All right, go here is the NQ 60-minute. Again, there's that big, what to me, very significant downtrend line right there. And we popped it. But other than it being a Fed day, as I said, take any breakouts with a grain of salt. The breakout also occurred in the final minutes of trading. We didn't get above it. Again, I'll go back to that 5-minute chart we were just on. See, there's where the breakout occurred. There was our previous high, remember, today. Right there was the tag of the trend line. So the breakout occurred at the end of the day. I also take breakouts that occur in the final 10 minutes of trading with a grain of salt. So that's number one. So where am I going with all this? Is, look, I had another great day gaming these little micro squiggles, selling shorts there, starting to scale in short, adding there as I said I would at the highs when we hit the trend line, gaming every bit of that pullback and then going long and gaming that. But at this point, I'll let this position run and I'll just stop out if it pulls back, probably below these lows there. I don't think we're going to go up much after overnight. It's hard to predict overnight, but at that point I want to be flat. So I may even be flat after this video. I'll let you guys know my thoughts. Well, I'm letting you know now in the video. I'm not going to do another one today, but I wanted to share my thoughts going forward. That's always the most important thing, and that's it. I'm going to go over the charts right now of we'll stick just with QQQ. If I had to go over every index, it's going to make this video run real long. We don't need to do that. I want to show you the market as a whole, and to do that I often look at the 11 sectors in the S&P 500 and or some of the market leading stocks. Also, the NASDAQ 100 is the leading index. It always is and always has been for decades now. Tech companies are the highest growth drivers of the economy, highest growth sector, and you're never going to see a bull market without tech leading. Tech always leads, and so we can watch the NASDAQ 100 for clues. And so, where I was going with the whole risk reward thing, remember the other day we were flirting with the recent lows, so the risk reward was skewed to the downside, but now we're comfortably above those lows. So at this point in time, unless something really big happens, really big, I'll quantify for you. It's, really big would have to be a 8, what is that, better than an 8% drop, or better, about an 8% drop, just to get back to those lows. So we're no longer on the verge or risk of breaking down, taking out the lows, and having a waterfall sell-off. So therefore, right now the risk is actually near term at least, and I'm going to speak to the longer term here in a second, but near term the risk is skewed to the upside because whether you want to give this breakout credit. Today we broke above all these previous reaction highs right there and the downtrend line, or what I think is a safer play, just give it a little question mark. It hasn't failed or anything yet, but it was a late day and it happened on a Fed day. But again, so let's say we pull back. We're still in close proximity of breaking out of the 60-minute downtrend line. And look, you guys know me. Back here, I mentioned it here and here is objecting shorting ops and objective shorting ops, and we got that short. What's changed since then? Well, at that point in time, we had negative divergence, which we do not have right now. We don't have divergence at all. We had overbought conditions this morning. We got that first pullback, but unlike that time right there, we no longer have negative divergence. So number one, that changes it and gives a greater chance of the trend line being broken, having a breakout that sticks. And number two is the fact I have just so many stocks, quite a few, and sectors either recently testing or in some cases breaking. Sorry, I had a distraction there. I had to stop the video. All right. So we have the breakouts, and we have quite a few sectors and other items breaking out, individual stocks, that is. We can look. You had a little spike above here. If you zoom in real tight, just keep that in mind. That's what happens sometimes. Late brief spikes, and you can fall back through there. This one's a little bit more than that. We can also, if we want to, give a benefit of the doubt, take a trend line and take it from this high, catch this previous high right here where we had that little spike over, and work the trend line like this. So again, all I'm trying to say is this, if you can take that breakout with a grain of salt, and maybe it'll follow through tomorrow. If we open, trade up tonight, the futures, and open way up here, well, then you've put that level in the rearview mirror. All right, and again, the other thing I wanted to mention as well, much more important back here. At this point in time, we have big divergence on the 60-minute chart and the daily charts. In fact, I'm just going to say it outright. These are, bar none, without a close second, the most bullish setups I've seen on the 60-minute and daily charts in a long, long time. That's many months. Now, the only thing countering that and then giving me a little pause from going all in aggressively long, which I'll maybe that in a few days, but not right now. I'll tell you why, because we're going to get to the weekly charts in a minute. But as of now, on the daily charts and the 60-minute charts, you have big bullish falling wedges that are right about the point where they break out. Wedge, that's the other thing. This is not where it wasn't a wedge, number one. We didn't have the divergence until this point right here. It is now a bullish falling wedge. And we're going to go to the chart of QQQ and then some of the individual sectors, and we'll wrap this up. All right, so you have QQQ. Here's that same 60-minute chart we've been looking at for a while right there. And you had this, a couple things. You have the similar, virtually identical, of course, positive divergence building as well. So you'll have the bullish falling wedge complete with divergence, and you had a late session breakout. That little white candle is just showing you the after hours trades, and there's still plenty of resistance levels ahead, but this is pretty significant, and again, less significant only because it happened on a Fed day. That doesn't negate it, doesn't mean it won't stick. We just need to see some follow through tomorrow. That's it. And if you see follow through tomorrow, well, You know me, I'll keep updating. You still have the uptrend line that I highlighted earlier today, so maybe we pull back to that. We could back test the trend line, and we do. That would be an objective long entry or a level to maybe cover some shorts if you are now wishing you did yesterday, or maybe you did and you want to get out of some more shorts. That's the thing. We could be looking at more upside here. Of course, if this whole breakout thing craps out, whether we have any follow through or not, if we drop down tomorrow, if we take out the trend line, we fall back below the trend line, then it's valid. And I won't even consider this a whipsaw because it happened so briefly right towards the close, and it was marginal by the close. Call it what you want, but we'll probably just take that trend line and move it up here like this. There's that previous reaction high, and that still takes you above it. So let's not obsess over this. I just wanted to recognize it, and more so the structure. The other thing that would keep me from shorting this and expecting the breakout to fail is, remember I talked about this in recent videos about a week ago. At this point in time, we had an uptrend back here, right? We were going to new highs, and that was the all-time high in the NASDAQ 100. And you would get these RSI thrusts. You'd have higher and higher thrusts up. That's that green arrow. Well, once we topped right here, the peaks in the RSI were lower and lower. They were diminishing. All these thrusts, the thrusts up in the market. This time around, we've now taken out for the first time. We have a higher thrust right there above the previous thrust. We're about equal to that level. We are certainly overbought. But remember, overbought is not a sell signal. All the better if you can get overbought and divergence. And that's what could happen here. So we're very overbought. If we get divergence, I'll point it out. Again, there's a lot of resistance levels there. So before I leave this chart, let me just go to the daily chart, show you QQQ. Again, here's the thing. Bigger picture on the daily chart. We had a reaction low that was double tested, and we've moved off it pretty impulsively, and we still have very strong and now a bullish crossover confirming that positive divergence. And you're also threatening. This is the same trend line that I give you on the 60-minute chart, but it's how it looks on the daily chart. And again, a breakout, but late in the day, and so it's still, I put a little question mark by it. So I will update this tomorrow. If we fall back down below, get rejected off there, if we break out, I will certainly give you my thoughts. But as of now, like I said, the risk at this point in time appears to be skewed to the upside, meaning if this breakout is likely to be confirmed tomorrow if we get more upside, and if it fails, well, we still have plenty of room to fall before we even get close to taking out those lows. In other words, another way to look at it is this wedge here could continue to develop. It could look something like this, another thrust down, and then still go on to breakout. But until and unless these divergences are burned through, it's hard to get too bearish, and it's hard to, you cannot dismiss the possibility that we could have a much bigger rally up there. That's what it looks like on QQQ. SPY is the same thing. We already put in a divergent low, never even tested that low again, and there's a downtrend line. So a lot of these indexes, a lot of key stocks, a lot of sectors threatening to break that. We're still not anywhere close to where we broke down a while ago, so we could have some upside. A lot can happen, and it is going to happen over the next few days here. Again, as I started in the beginning of the video, I'm going to keep things light, and that means very little, if any, market exposure. I'll highlight and get to other trades in a second. I still like crude, still hanging in there right now for the time being on the longs, but let me give you a quick update of the sectors of the S&P 500 here and show you my thoughts and what goes into my thinking. Okay, this is XLK. I know there's a lot of lines here, but probably the most important line right here, you have good support at about 140, almost 147, right? It was, we had a breakout here to new highs. We back tested it successfully once, twice, 3 times. We had that whipsaw. I spoke to that. That was when Russia invaded right there. And then we went through there a few more times, but look, we regained it. So no matter what you want to say about the Fed, this, that, you have to take this right now on face value. It means this is a bear trap, aka false breakdown. These breakdowns, we recovered and we snapped back above the support. And until unless that fails, it is hard to get too bearish. And if it does fail, boom, these new lows aren't too far below, and then that's where I can add back the short exposure that I recently covered if that happens. Otherwise, right now, like I said, the risk is for a breakout of the downtrend line, and there's so many. I already went over this QQQ. I went over it in SPY. Here it is in XLK. And it's pretty powerful when you have not just one index, but multiple indices and or multiple sectors and key stocks all breaking out around the same time. What happens, a lot of buy programs are hit. Short sellers have their stops hit. Could prove to be a whipsaw, but this is what I'm looking at, guys. I'm looking at these downtrend lines. Then above that, you have the moving averages. The indexes in a lot of stocks and sectors certainly have their work to do, even if they take out those trend lines. With by that I mean plenty of big resistance levels overhead. You can see on XLK, other than the trend line, it's a 200-day exponential moving average. Above that is a 200-day simple at about 157.70, then price resistance about 160, and then the next big resistance about 164. If it takes all those out, that's nothing but bullish. You know, there's still previous highs, but that's going to be real bullish because that's a mountain of pretty thick resistance. Now, from the scope of these divergences, you know, if these positive divergences play out as they have in the past quite often, the big daily divergences, you know, you're talking new highs and beyond right there. It's too early for me to say that because we have to break out. We haven't even broken out yet, and these divergences still could be negated if we have another dump down. So I'm eager, and I'm going to get to the weekly charts in just a second when I wrap this up, and I'll speak to that because that speaks to the longer term case. Remember, this week is a week of volatility. We knew it would be, and it has been so far. And it's a week that I tend to take everything with a little bit of grain of salt. But because of everything I'm just telling you now, there's quite a bit of bullish developments or potentially bullish developments, and too little to ignore and just dismiss as FOMC noise, if that makes sense. So, you know, it's been a good run in the last few months, both long and short. You know, the long trades were quick tactical bounce trades, mostly short. But at this point in time, there's nothing wrong, at least in my opinion, kind of sitting tight on the and just watching, not being a participator, but more of a spectator. And now let me go to the rest of the sectors. This is a big one, by the way. That's XLK. And so again, the most important development there recently was the fact we had a few breakdowns through there. We successfully defended these lows on multiple occasions, about 141. We put in a divergent low, and we're moving impulsively higher. And each additional break above those resistance levels I've given you are nothing but check marks if we get them. Any failures there, followed by a rejection, well, you know, you can hit it and bounce back. It's really now we need to take out those recent lows to do some serious damage, because any rejection now is, if it gets bought up, is just going to has a potential to only extend that wedge, and maybe the wedge breaks out instead of this week. Maybe it breaks out 3 weeks from now. All right, XLV. All right, this is a bullish development. A couple, maybe a week or two ago, I highlighted this level here, 124 roughly, as big support. That was the all-time highs right here in XLV. That's the second largest sector in the S&P 500. We had some consolidation, then a breakout to new highs, and it went up, fell back down, tested that level again, ran up, had a false breakout and a big divergent high, fell back down, check, check, keeps checking 124, but never broke it. So this one in itself, you know, I could sit here all day long and tell you, well, this was bearish because we broke that trend line and we back tested, but this is really my BOD line. That's why it was colored yellow. We need to break that, and we haven't yet. In fact, we're far from it now. We're even closer to this uptrend line right here, and closer to the new highs than we are actually to that 124. So there's no risk at this point in time of the healthcare sector breaking down. That could change, and if it does, I'll let you know, and that's why I'm doing this. So far, the first two sectors and the largest sectors of the S&P 500 tell me right now, don't be heavily short. Xlf Financials, there's another one with a recently bullish development. You had a breakdown of this level. I had my yellow line there, about $37. It was really good support. We broke out to new highs here. You set up a trading range right there, and the top of that range was 37, and we broke above it, tested, broke it recently, and that proved to be a false breakdown, aka bear trap. Now we hit next support level, which was my first target, and at that point I said, look, I threw it out to you a few days ago. We had an objective short entry at 37. We were back testing 37 several times, but look, we gapped way above it today. This wasn't a marginal slight recovery. The financials popped way back above that level. And I guess there was maybe I wasn't around. Normally I'm in front of my desk at the FOMC meeting, so I wasn't able to turn on the TV and just or even read through yet what Powell said. I know we got a quarter-point rate hike, and that's all I know. But I imagine he did his usual Jerome Sunday morning Powell, I call him because he's easy like Sunday morning. Quarter point. No, yeah, we'll keep an eye on things, and we'll probably gradually raise. But again, all he's done now is a quarter point. Remember, take what the Fed says and throw it in the garbage, because I know the Fed, they're going to pivot and change. They're reactive. So whatever plans they have today can and will change depending on how things develop going forward. That's inflation, the economy, and most importantly, their baby, the stock market. So anyways, all that matters today, we got a 25 basis rate cut, and I'll read through again, our rate hike, I'm sorry, and I'll read through and see if there's anything else. Financials aren't out of the woods yet. That is powerful. Bear traps, false breakdowns are pretty powerful buy signals, but there's still next resistance here. It's pretty significant at about $39. If it takes that out, well, you've got your previous highs, but like I said, that would be nothing but bullish. So unless this proves to be a one-day little whipsaw, or this week really, I'd like to see how we close the end of the week and follow through next week. But right now, check mark for the bulls. That's all I can say. If it fails and it turns out it was a big old whipsaw, then I'll let you know. There's our uptrend line, potential uptrend line that's forming. It's something to watch. If you're bullish, you can buy pullbacks to the trend line like that. You could buy a breakout above 39. If you're bearish, well, I hate to say it, you probably have to wait for a break of these recent lows and everything else, all these other sectors that I'm talking about here. XLC, communication, positive divergence. Like I said, big, I sound like a broken record, but that's what, again, has had me start to pivot here, because we have, and I've been recognized these divergences, but we've had more now, where I started talking about them a few weeks ago. Just in the last week, you can see here, that's when XLC and just about every sector that didn't have bullish divergence since has had it, and now it's starting to move away, confirming the divergence by turning the PPO up. And so again, something we monitor. If we go down, maybe we burn through the divergence. If we go up, still plenty of resistance levels to get taken out, but if and as each one is popped, meaning they take it out, then that's most likely the catalyst for move up to the next resistance level. Xly Consumer Discretionary. Remember, I'm doing these in order of weighting in the S&P. So as I go down the line, this is still a significant one. It's about 10% of the S&P 500, but it pales, in comparison to the 25% or so weighting that the tech sector has. And that's it. You have this. There's your divergence line. You can see them drawn down here on the indicators. Same story. So I don't think there's anything I can find. Yeah, even this one here. At least RSI divergence, almost PPO divergence. This is the industrials. But what the industrials did recently, and I highlighted, we had a big level there. That is look just like IWM, about a year-long trading range, right? Well-defined sideways range. Broke down, I mean, from scale 1 to 10, the breakdown looked like a 10. We were way down there. We hit the next support level. But from there, boom, the buyers stepped in and they ramped it right back up into the trading range. And then I told you have a midpoint in most trading ranges that I've noticed. You can add a midpoint line right around the middle, whether it's a sideways range like this or a upward sloping price channel. Quite often I can draw a line about in the middle, and that you'll see prices trade above that line. Then once they break it, they go to the bottom and they trade below. And so that's what's happening here. So we are at resistance. If we get rejected, well, for now, time being, it keeps us in the trading range. Really, to change things significantly, you're going to have to take out the bottom of the range. However, an upside pop of the range, although once in a while you get a day or two above it. But if we can solidly take out the middle of that range, then probably going to send us to the top. If we get to the top, Well, after everything that's happened in the divergences, who knows? Maybe we see new highs. I certainly can't rule them out now, and I'll tell you the odds are a lot higher of new highs than they were a week ago. But again, I'm going to wrap this video up on the weekly charts and tell you it ain't over for the bears yet. It's still anybody's game. XLP trend line there. Look how beautiful. When I say beautiful, just the number of clean, distinct reactions along this thing. It's got to be not even counting each candle. You have multiple candles on each cluster, but just the clusters alone are numerous, including right here recently. And then boom, look at that false breakdown. This is what I'm seeing. This is not what you want to see when you're short. Breakdowns are great, but when all of a sudden you recover the level, that is again what you call a bear trap or a false breakdown, and it tends to suck in shorts and then cause a lot of short covering, and it also emboldens bulls when they see that the trend lines and support levels are recovered. Now the work to be done, there is work to be done. You have to take back this level. You had a little descending triangle pattern right here, and that broke down, and then we're back testing it from below. So I know there's a lot going on here, a lot of moving parts right now, but most importantly, I'm seeing too many breakdowns that have failed at this point for me to want to add back any short exposure at this point in time. And there's the trend line, of course. If we hit that, that's also resistance. You break above that, it's hard to spin that as anything but bullish. So it hasn't happened yet. We'll watch it. And this one is consumer staples. It's about 8% weighting in the S&P 500, enough to move the needle somewhat. Go down the line, energy sector, oil, has abated. Big divergences here. Energy sector has gotten ahead of itself quite a bit, so hard to say. And of course, these are energy stocks, not crude oil itself. I'll probably have to get to crude in another video because this one's going long enough. Utilities, not going to move the needle much, only about 3.5% weighting in the S&P 500. And it's just a defensive sector. And it's also an interest rate sensitive sector. So if anything, if the market goes up, if those growth sectors that I covered, those are the tech and consumer discretionary and all those, if they do happen to continue to rise, you're almost most likely to see money coming out of safe havens and defensive sectors like utilities, and this one would probably go down. You got to short a lot of XLU, or you buy SDP, I think, SAM, Delta, P, whatever that would be. SDP, if it's still around, I haven't used it in ages. I think it's a 2x short utility sector, and that would be likely to go there. But I'm not, again, I don't trade that. There's just not a lot of juice there. You've got to burn up a lot of margin in your account to leverage up to make money in utilities, and they inherently go up. They're steady Eddie dividend paying stocks. They're recession proof because you don't stop paying your electric bill during a recession, and so they tend to hang in there. XLRE, the REITs, again, that was a beautiful wedge breakdown, and it played out for a nice trade. We shorted this one back here before the breakdown even, and it was a nice drop, nice trade. I think our short entry was about right there, and we hit, we just took out about a 13.5% drop, and I had a yellow line right here at 44.10. And again, this is a common theme I'm seeing, and I'm seeing too much of it. Breakdown, solid breakdown, but actually that wasn't even a whipsaw. Not if you're trading on the daily time frame, because you broke it intraday. The candle was green. That means we closed back above, so it was not a confirmed sell signal. On a daily chart, all that matters is how your candlestick closes the day. So in a sense, it was a whipsaw because it was an intraday break, and it was pretty big. It looked legit, but then you reversed and got back up in there. So another successful defense of support. And again, so until the REIT sector takes out 44 and takes it out with conviction, and that is possible. This PPO is in bearish territory still. We have resistance overhead. These are all the things I'm going to be looking at, guys. All right, so last one, basic materials. Here's one that just broke out. You had a downtrend line, which is pretty clean. Looks like the downtrend line on a lot of the indexes I showed you earlier. and you have nice, clean, positive divergence, and today a breakout candle. Again, I take it with a little bit of a grain of salt. It happened on a Fed day, but if we can hold that breakout, then it's just one more sector that has a constructive chart. And most importantly, like everything else, again, might sound like a broken record, but we've got big levels. This is a level I've had highlighted for a while in yellow. It's my big level. It needs to be taken out to increase the odds that my next targets on the weekly chart are going to be hit. And in the last few days, all we did is we kissed it a week ago and have been moving higher. And so that's it. Those are your 11 sectors in the S&P 500. And to take this video home, let's not forget longer term traders, investors, trend traders. If you have short positions at this point in time, there's nothing wrong with that, because all this is at this point in time, and it can change. Today is Wednesday. Wednesday is over, so we have 2 more trading days in the week. You had a break of my first support and target, which was hit back here on the weekly chart. Way back then. That was the week ending of January 28th. We got the expected bounce. We were able to game it. Then we went down. Then we took out that level. We were moving lower. Halfway to my next target, around 299 to 300. But when we zoom in tight, you can see here what we've been doing lately is defending these lows. The week is not over, but this is not what you want to see for that whole bear flag scenario. Remember, you had the impulsive leg down, i.e. the flagpole, followed by a bear flag, and selling up until this point. We had one green candle, that's it, just like we had one green candle on the way down. But now this green candle doesn't help that. If we close the week where we're at or any higher, you're also going to have a bullish engulfing candlestick. Bullish engulfing is this when you have a big green candle and it engulfs the body of the previous candle or multiple candles. So you have the potential to engulf, all these, depending on how we finish the week, or something happens, the market craps out in the next 2 days, and this is a weekly candle, so it's big and green right now, but we could close down here red. Anything is possible, but as I laid out right now, there's those bullish developments that I've been highlighting have only firmed up more so, and now that we're at risk of breaking out of those 60-minute downtrend lines, that could certainly lead to quite a bit more upside in the coming days, possibly the coming weeks here. So this is it. We'll see how we close the week, and at that point, I'll all along, I'll be around tomorrow. I'll be around Friday. I might not be trading very actively at that point, but we'll see. And then, of course, I'm going to turn my focus to other things, other individual trade ideas. I'll revisit those Chinese education stocks. They've had quite a bit of. They had a big move down, and a lot of them are rallying. And one of them actually might have. Let me see. It might have hit the target today. And they got YQ. That first target earlier today, I noticed. Oh, look at that! I hadn't checked it earlier today. It was coming up there, and I was going to give an update, but it was focused on the markets. This is T1 here. This is one of those I laid out. It had a breakout back test. So from the breakout point, we hit my first target today, and that was good for 112% gain. The high of the day was 308, and I always say these are unofficial targets. Unless I do T1 equals, T2, they are what I've moved to over the last year or so, getting away from the adjusted targets because it gets too time consuming and also too confusing when you see that. So the 315 is the actual resistance level, and just like I said this morning, and I say often, if all eyes are looking at 315, when you get to 308 or 309, when you get close to that level, why hold out for a few more pennies when you're already up over 100% and risk missing a fill? Because that's what traders do. When all eyes see a level, you're going to have some sellers, some longs take profits a little early. So anywho, I'll do the rest of those later. This video would go too long. I'll also update crude, lumber, everything else we've looked at, and we'll certainly pick it up tomorrow. So that's it. Yeah, can't think anything else to add to that. Let's just see where we go from here. and see really again if this proves to be just more Fed noise, because usually that Fed FOMC noise, meaning the whipsaws and the big moves, that starts to abate by the end of the next day. We'll kind of have a clear idea of whether this move in that late session breakout that we had today above the QQQ trend line is going to stick, or if it was just a random spike from the post-Fed volatility, and then we'll pick it up and go from there. This has been Randy Finney with Right Side of the Chart. Have a great day.